That's great. Thank you. And the mentioned book, of course, John is also a great gifter, a scrappy gifter, where he gave me the textbook. It's throwing me back to college. Thank you so much.
It's a very tactile experience.
Yes, exactly. The lost art of reading physical books. Thank you so much for joining me today, John. This is actually my first Traders Expo. It is a packed house in this Platinum Room. Thank you so much for spending the afternoon with us.
And to you guys, great work.
Yes,
great work.
Exactly.
Nice work.
Kudos to you. I think this will be a very interesting discussion. Of course, the topic is how to trade the Fed, but that's just a sliver of the conversation I want to have with you, just given your various expertise. You know, your LinkedIn profile is quite diverse. Whether it's a trader, a consultant, an author, you're also in law school right now. So you're trying to figure out how to manage risk. You've also been living in Vegas for the past 15 years. So what better way to start than explaining to us what the Netto number actually is and what is so proprietary about it?
Sure. Well, I think when everyone who comes here today thinks about what their investment mantra is, the first thing that most of us are taught about the markets is, how much did I make? What was my return?
Yep.
It's a fair question, right? I made 5%, I made 10%. And that's what I would call the first dimension of performance analysis. The second dimension is what you see from a lot of institutions out there, whether it's the Sharpe ratio, the Sortino ratio. They measure things in context in terms of the volatility around it. So maybe Yahoo has more volatility than
now Verizon.
Exactly, than Verizon, all right? Or now Verizon, Verizon more. At any rate, and then the third component is, and this is something that is appreciated at the professional trading level, but is something that is not as widespread or understood at the retail level or the mainstream level, and that is understanding what your returns are relative to predefined risk.
Right.
So if I were to give you a portfolio and say, listen, here's $1 million, Melody. If you lose $200,000 on that, I'm going to pull the portfolio.
Right.
And we agree on that before we even start. Whereas I take another portfolio manager and say, listen, you can lose $500,000 of that $1 million before I pull the portfolio from you. Well, at the end of the year, you're up 20%. That other manager's up 20%. Well, you had less risk premium. You had less flexibility premium to work with. And so the Netto number measures what your budget was and how you did based on your budget. And that's important context because when you look at investment strategies out there, someone can see that a portfolio made 30% or 20%, but they don't know what was at risk. And so the Netto number gives you a context to where I can compare the portfolio that on a 20% risk budget made 10% with a portfolio on a 50% budget made 20%. And the Netto number lets you normalize those, and you can say, whoa, in a heartbeat I can compare the price of Google with a real estate investment in California.
And, you know, each individual has a different level of risk they want to actually take. You have acknowledged that you tend to err on the riskier side. So when you're advising your own clients and thinking about their portfolios, how do you make sure to, you know, stay silent when you need to and try to understand and meet the customer where they are?
Sure. So I have three key concepts that when it comes to identifying a client's needs that I try and fit them all into this respective bucket. The first, as I talked about, is does this investment within the context of your investment objectives maximize return per unit of risk? Okay, and that is whether you have a small risk appetite or a large risk appetite, you're looking for a certain return profile upon that risk appetite. So that's the first thing. The second thing is we got to get a little creative here, all right? What is the structure that you're investing in? All right? Some structures are more conducive giving your profile than other structures. And so we want to add a structural edge on top of whether the investment maximizes return per unit of risk or not. And then lastly, does this investment solve a problem? The more systemic, the more profound, the deeper, the more complex the problem is, if that investment solves that problem, the more viable that investment is, the more sustainable that investment is. So if you can ask these three questions, whether I'm asking them with someone I'm collaborating with, or whether you ask them about yourself, how does it maximize return per unit of risk? What's the structure and does it provide value? And is the problem it's solving systemic, thereby increasing the viability of this investment going forward?
Yeah, what better case study to take and using this paradigm than the Fed? and all of the Fed's actions or inaction over the last couple of years. Just 2 weeks ago, the Fed did cut interest rates for the third consecutive time by 25 basis points, and now the understanding, the general consensus is that there is a pause momentarily. Even when you think about the Fed's actions over the last year, let's say, and Jay Powell's commentary, how have you been able to parse this Fed speak and sometimes kind of the discrepancies between their statements and then the press conference that follows?
Sure. So before I talk about my approach to the Fed, let's just take a step back for a second and think about more broadly, how do I look at the markets? How do I approach and define opportunity? So when I talk about maximizing return punitive risk, the type of markets that I look to, and even in the global macro edge, it's about Nice plug. It's about incorporating the macro narrative into underlying technical analysis, and here's why that's important. When you identify what regime you are in, there are certain strategies that work better than others in certain regimes. So when the Fed comes out and makes a statement that catches people by surprise, the market invariably has to go through a reprice. That reprice, there's simply not enough liquidity in the market that allows this reprice to happen instantaneously. And so the global macro edge, and really the core of my philosophy, is understanding what the underlying fundamental narrative is so that when that changes from big institutions like the Fed, we're in a position to act on it and identify those opportunities to achieve those outsized gains, which ultimately helps us maximize return punitive risk. I want to risk one, take as little drawdown or heat as possible, and make 3 or 5 or 7 or 10. That really happens when you understand the macro narrative and when there's been a shift of that narrative suddenly beyond market expectations. And so when you talk about how do I trade the Fed, now let's look at some Fed examples of when that applies.
Right.
All right? So let's go back to December 2018. This is December 18th, December 19th, what precipitated a pretty nasty sell-off to end 2018. And what that really stemmed from is there was a big perception out there, a big calling from the investment community for the Fed to not even hike for the final time. It was December 18, they hiked, but the language put in the third paragraph of the Fed statement that suggested that still some interest rate hikes were still forthcoming was not only anathema to those calling for no interest rate hike, but the fact that the Fed was still going to hike rates and create even more tougher or more difficult financial conditions presented a real problem, and most importantly, an unexpected problem. And so Jay Powell comes into the press conference where some people thought, okay, he'll clean this up a little bit. And in the press conference, he didn't clean it up.
Yeah.
Further confusion, but almost a bit of hubris about, no, we're on autopilot. We're going to keep hiking. And so for those that saw that over the next 72 hours, the S&P was down 700 basis points. And so those reprices, there is not enough liquidity in the market to process these things in. And so if you understand the macro narrative, if you appreciate the strategies out there and you understand the Netto number and how to maximize return punitive risk, I don't want to make 7%. I want to make 7% on a down move by only risking 25 basis points. Because But
on a practical level, you just noted that was a surprise, right?
Right.
And then even Powell's commentary is not necessarily what investors and analysts are able to predict.
Right.
So how do people in the room create those scenarios? How many scenarios should we be making when we're thinking about when Powell speaks?
Sure. So let's use Powell as a metaphor, all right? When Powell speaks, or when anyone speaks, or when an event happens in a stock you're following, it doesn't have to be the Fed per se.
Right.
I follow the Fed because I'm a macro guy. I love all the connecting parts and connecting the dots. But whatever it is that you study, you need to both objectively and subjectively appreciate what the factors are that move those markets and what the underlying narrative is. If you own healthcare stocks right now, or our previous presenter just addressed stocks that were adversely impacted by the China tariff news. Well, if you appreciate that 70% of the discount in this company is based on the China tariff news, we had talks out of the White House last night and today, or at least coming, that not only were they going to put phase 1 moves in with China, but potentially they'd roll back tariffs. The market is not ready for a potential rollback of tariffs right now. We've all kind of factored in that that's just going to be part of the rhetoric that goes on. So if you're following those companies and you can objectively appreciate that the tariff news is embedded or has created a discount in that price, you're ready to act because it's not going to necessarily it shouldn't, I never say not, I never say categorically anything when it comes to investing, or at least I try not to, is that when these circumstances arise, your subjective appreciation of these things, of this narrative, is what puts you in a position to where you can create, you don't need to have 50 different ideas out there, but 5 or 7 that you specialize in. Because the news hits, it hits the desk. Our friends over at Verizon share this with all of us here. And like, wow, Melody just brought out a great story to me about how the tariffs could be easy. Well, let me follow this stock. Is the underlying price action confirming that they're actually working past this? And I would say, when you look at some of the broader market indices out there, something that, again, bringing this in terms of something that's practical and applicable, look at the DAX right now. Look at European equities. Look at the Nikkei. All right? The theme for the last year and a half since we had tariffs off and tariffs on again, if those of you who like risk off or risk on from back in the day, is that a lot of global money out there found the 50 biggest U.S. large cap stocks out there. It dumped their money in that, and you saw serious lagging from emerging market equities, from the DAX, from the FTSE, as the rest of the world really struggled economically. What do you see right now? You see a lot of cash being put back into broader global equity indexes, and they're rotating out of those 50 big large cap stocks. If you're wondering why the S&P, which has been up but has underperformed the DAX, the FTSE, the Euro stocks, FTSE a little bit less, they had a Bank of England this morning, but if you're wondering why the S&P the last 3 days is not quite as performing as well as others, it's because money's coming out of those 50 large cap stocks and following those international. So if you know these narratives, you can now overlay this narrative, identify the right trend following strategy in these global equity markets and play that. And that's the global macro edge.
Always comes back to global macro edge. I feel like you rehearsed this at home.
It just comes natural.
Yeah, clearly. One thing that you actually wanted to highlight is Powell's comments during his last press conference, where he specifically said, quote, "We're going to be watching all factors, and if developments emerge that cause a material reassessment of our outlook, we would respond accordingly, but that's what it would take, a material reassessment of our outlook," reiterating that point. You're shaking your head. When you hear a statement like that, what is that a trigger for you?
Who here remembers when Tom Cruise went on Oprah Winfrey to say how much he loved Katie Holmes? He jumped off the white couch. That's kind of what these seats remind me of. Well, right now, when you ask me that, I feel like Tom Cruise with Oprah, and I want to jump up on this chair and like,
please
do you
don't.
realize that was a bad moment for him, bad optics. So here's the thing. In the second paragraph of the Fed statement, the Fed effectively says that they believe that they have 2 mandates. One is full employment, the second is price stability. In essence, they're going to be able to reach their inflation, their symmetrical inflation objective of 2%. Asymmetrical is what I want when I find a good risk-reward trade. Symmetrical refers to the Fed's inflation target. This is how I think in real time. So here's what they mean by that. Their inflation objective is to reach that symmetric goal. Back in June, the ECB, during one of their press conferences, talked about not only reaching their inflation objective, but reaching and sustaining their inflation objective. That commentary right there effectively told the market that we are having a de facto change of our mandate. We're no longer looking, by saying that it would take a material change, we're no longer looking to just reach our inflation goal. We need to blow way past it, okay? Now combine that with the easing of tariffs, with the trade talk going on between China, and what you have in the last 3 to 4 days is an unwind of global risk premium out there. Who here thinks they can tell me what's the single worst performing asset class over the last 3 days? 30-year treasuries, okay? That 30-year treasury falls on the heels of those remarks that, guess what? The Fed is going to try even more now to make that inflation is not an issue. Yep. Because instead of us reaching that goal, we're going to reach and sustain that goal. And so as someone who's actually studying for the law school admissions test right now to apply to law school, I can tell you that I am in law school, but I'm in a master's program right now, and it's a long story. The bottom line is, if anyone has ever had the misfortune of taking the LSAT, one of the most common components is what's called a logical reasoning section. And in there, one of the most common questions, as I think it appears the most, is, based on the above information, what can you assume in the following statements, okay? And so if we play that game out, the sort of LSAT test for everyone, here's your one sample question, all right? Based on the Fed statement, okay, what can we infer from Chairman Powell saying that it would take a material change for us to unwedge ourselves from this current Fed funds rate? A, we're going to let inflation run hot. B, we're going to do nothing if deflation comes around. I don't believe that for a second, okay? C, we're going to be really concerned about every little tick in the data, That's false, okay? And so you go back to A. We're going to let inflation run hot. That's what we can infer and conclude from those comments that he stated and then repeated again. Treasuries, one of the biggest sell-offs of the year. Gold, one of the biggest sell-offs of the year. This is risk premium and the reflation trade coming back into effect. And this is what set these up.
You know, one thing that I find fascinating about even your asset allocation as you talk about some of those asset classes is you're not just equities and bonds, right? You try to think about real estate. You try to think about physical assets and where else you see opportunity. You know, we were talking about the $4.5 billion that tech giants Apple, Google, and Facebook committed to hopefully partake in the eradication of homelessness in Silicon Valley, which is a long shot, right? There's an epidemic happening there. Where do you see the opportunity in a case like that? Is that something that you feel as though as an investor there is a way to capitalize on these companies getting in?
So I would recategorize that question as where don't I see the opportunity in the space?
Yeah.
It's so profound, it's so omnipresent, it's so ubiquitous. And let's just take a step back and go back to my investment philosophy and why I think it applies here. So what Apple, Microsoft, Amazon has done is laudable, but what we need is a real market solution. And so I ask this, what structure out there allows me to maximize return punitive risk? What structure, what provides value through the structure? And then ultimately what solves a systemic or sustainable problem, which in this case is real estate. And so you think about companies like Uber, like Airbnb, and what they've effectively done in this shared economy is better utilize an idle resource, okay? And home equity is the next idle resource, okay? And through home equity contracts, the idea that we can fractionalize home equity, not home loans, because let's take the school teacher who lives in the Bay Area. They make $70,000 a year. If that. If that. They bought their home 20 years ago for $150,000, $200,000, probably a little more than that. It's now worth $1 million. 95% of their net worth is tied up in their house. Now take the 30-year-old millennial couple that wants to own real estate but can't. How do you bring those two together? Home equity contracts are the way to do that. So listen, while you can offer low interest rate loans, you can offer assistance, but what you need is a commercial solution that allows institutions, people who want to actually participate in future appreciation of homes and allow homeowners to better diversify themselves. And so when I think of that problem, when I think of $4 trillion of trapped equity in California, when I think of $15 trillion of trapped equity in the United States, and how inefficient that equity is being utilized, if you own a home that's worth $1 million, and I say, here, Melody, I'll give you $200,000, all right, so I can participate in your future appreciation. You get to diversify out, you keep that, and I participate in the future upside. All of a sudden, we both get what we want. You diversify your portfolio, and I have a way to benefit from upside appreciation in real estate.
And I've covered some of those startups that are working in this area, right, in the past. Why isn't it gaining more commercial attraction?
I think it's gaining a lot of commercial attraction. We're seeing the things you talked about deal with some of the existential problems that exist out there. But you look at companies like Baristone, like Point, like all these firms that are coming up with real estate. They're blending actually financial technology and real estate in a hybrid of an old world and new school solution that I think provides tremendous opportunity.
You know, I want to kind of do a quick lightning round of some excellent topics that we have discussed.
What was before this? That wasn't a lightning round?
That was not quite a lightning round. That was the fireside part. Will the Dow hit 30K by the 2020 election?
Yes, it will, because the Fed is not going to cut in an election year for the reasons we just talked about. The Fed, as we said, it would take a material change. I'm not going to hike, sorry, in an election year. The Fed, as we talked about, would take a material change. What that really means is if you look back in Fed history, it's very rare that they hike or make any interest rate decision during an election year. So now imagine the Fed, which says we need a material change, is now not going to hike regardless of how good the economic data is, even if the China tariffs get rolled back, no matter how low unemployment gets, because they want inflation to sustain itself above the 2% level now, okay? That is the perfect kind of environment for reflationary trade and for the Dow to go higher. You throw in that all the cash on the sideline, you throw into that all of the lack of performance with the first quarter this year, and money managers still behind, it's a very bullish environment.
When you look at the brokerage industry at large, what is your thought on commission-free trading and how it will affect the industry overall?
Well, I think that if you understand the brokerage model out there, and having worked in the brokerage industry in the past, that brokers earn their money in a lot of ways, and I think it's gonna reshape what the brokerage model is. Because if I pay commission-free trading, but then what I give up on the float, because for those of you who are familiar with rehypothecation of stock, it's going to force me as a broker to do more with that stock inventory that I have and do more with how I market those trades. So if I'm going to buy 100 shares of Amazon, I may route it to a market maker that lets me earn my keep on the fill of it versus earn it on the commission side. I think the commissions, in many ways, are an optical issue. But if you're a broker that's dynamic, you understand where it's really at. It's how you manage your float inventory. If you have a client that owns shares that you can rehypothecate and short out or lend a short to other places.
Kind of a follow on that. What does your job look like in 5 years?
Well, my job looks like, I would answer the same way I would answer that from 5 years ago. I am the protean trader, adaptable, versatile, able to take on many shapes and forms. And I would say that what it will look like is not what it is today. But what it won't stop being is about the principles that I believe in. I identifying trades that maximize return punitive risk, whatever that comes from. Identifying structures that provide value, whatever those structures look like. And identifying investments that solve a systemic problem. Those concepts, those principles are solid. They're foundational. They're transcendent.
And besides home equity contracts, what would you say is one kind of not overlooked opportunity, but for people sitting in the audience, something that perhaps isn't getting as many headlines, isn't getting as much coverage? You know, I'm very cognizant of my role in media, where sometimes it becomes regurgitation of the same thing. So what's something that has really caught your eye that you're particularly excited about?
I think the spread of sports betting. For those of us here in Las Vegas, the Supreme Court decision last year or 2 years ago was obviously very influential. We're seeing more and more sports betting operations set up around the country, and that type of growth, that type of interactivity that we're seeing leagues adopt. We're seeing the NBA work gaming contracts with private sports betting outlet for their data. So this sports betting theme is also as much a play on data and how that is being branded, because what is one of the big reasons why streaming, to our previous presenter, has been so successful, and that is the DVR. The DVR has actually increased the value of sports franchises because it's sports that is the glue holding cable together right now. Because you don't go back and DVR. Some of us go back and DVR a game if we're a half hour behind, but you don't watch a DVR of a game 3 days later. You're less likely to, So the sports industry is really what is keeping cable alive right now.
On that note, let's give it up for John.
Let's give it up for Melody.
Woo! Thank you so much.